residential housing investment is in a deep recession. That's the first thing. And then the next thing is the financial system, the banking system, where you start to see the weaker banks start to fail or get into trouble. So that's exactly what we're seeing now. So what I'm saying is these are the sort of road signs that we'd be expecting to see, and they don't, and they don't sort of just alleviate quickly. This is exactly what happened, by the way, prior to the sort of 07-08 downturn. It was just a bit more extreme, but the sequence of events was exactly the same.
Our next guest is Dhaval Joshi. He is the Chief Strategist of Counterpoint at BCA Research and will be sharing his insights on the macroeconomic landscape as well as his overweights and underweight positions right now. Dhaval, it's a pleasure to host you. Welcome to my show.
Thank you for the invitation.
Thank you for being here. Full disclosure, I used to work at BCA Research. It was my first job out of college, so I know firsthand how rigorous the research process is, and I know firsthand how brilliant you are as a strategist, so I appreciate you sharing your insights and your time with us today. I think the audience would like to know, first and foremost, your positioning and your investment thesis. So let's set us up with your asset allocation. I'm curious just to understand why in one of your recent reports, you wrote that U.S. banks are a technical rebound. Rather a contrarian title given the amount of negative news we've been hearing around the banks in the news. So tell us about why you think banks could be a buy right now.
Sure. I mean, I think that when anything falls by 25 to 30% in a matter of days, you have to sort of question how much bad news is already factored in. So, I think that the question about banks is really, is there going to be a recession imminent? In which case, they're not, they've got further downside. But I think that the reason that we can have a rebound is that, I mean, my real take is that there's something really odd going on, because you've got one sector like home builders, which are doing extremely well, and another sector, banks, which are going the other direction. I think something's wrong. If banks are saying, look, there's going to be a massive sort of credit tightening about to hit the economy, then home builders should not be flying. And if home builders are right saying, actually, you know what, things are not really that bad at ground level, then banks should not be down 30%. So I was really sort of pointing out that real anomaly between two sectors. One has gone up, 35% or so in the last few months. The other's gone down 35%. That doesn't make sense to me.
Right. You do have a chart showing the divergence between credit spreads and the home builders. And that, huge divergence, like you said. If this divergence were to close, which variable do you expect to move more, the home builders or the credit spreads?
So I mean, I'm basically saying with tightening credit conditions, and that's really one of the repercussions of that sort of mini crisis we had in the banking system. With tightening credit conditions, it's difficult for the home builder rally to be justified, or the extent of that rally to be justified, right? Because it's going to be harder to buy a home, and therefore the need to build homes and so on will also be impacted. So if that tightening of credit conditions that has come off the back of, Silicon Valley and, the other sort of bank failures, if that persists, then we're going to see the impact of that on the economy in the next few months or so. And that makes it hard to justify that rally in home builders. If it proves to be a very, very short-lived hit to credit conditions, which I think is less likely, then it'll be credit spreads that, come in again. But I think that's the lesser likely of the two possibilities.
Just on the bank sector, going back to the banks, we've had business leaders like Jamie Dimon, for example, JP Morgan CEO, saying recently that he believes the banking crisis is not yet over. Others have shared a sentiment. Larry Fink of BlackRock earlier in March has also said something similar. Is this a statement that you agree with, Dhaval?
Yeah, so the way I see the bank failures and bank crises is that they are exactly what you would expect at this stage of a tightening cycle. So, all the people who said, whoa, there's something's blowing up in the banks and expressed shock and surprise, I'd say, well, look, this has always happened. This is, in a tightening cycle, you kind of get a sequence of events. the first canary in the coal mine, as I like to put it, is housing investment. And we've seen housing investment, residential housing investment is in a deep recession. That's the first thing. And then the next thing is the financial system, the banking system, where you start to see the weaker banks start to fail or get into trouble. So that's exactly what we're seeing now. So what I'm saying is these are the sort of road signs that we'd be expecting to see, and they don't, and they don't sort of just alleviate quickly. This is exactly what happened, by the way, prior to the sort of 07-08 downturn. Probably it was just a bit more extreme, but the sequence of events was exactly the same.
I do want to get your outlook on the economy and this incoming recession, if there is one, in the labor market. But first, let's update the audience on your asset allocation. So what are your top overweight sectors right now?
So I think that if I'm correct, and we are heading into a recession within the next, it'll be a sort of 2023 start, then, bond yields are going to head lower. And we've seen the peak in yields. So I think, bonds are going to rally. They've been rallying very, very gently, and not in a straight line, but we have seen sort of, it looks like we've had the peak in yields. And therefore, from a equity perspective, you want the plays, the sectors that benefit most from falling yields. So there's two ways of thinking about this. Falling yields means that you're in a kind of slowing economy, so you want to avoid sectors that have got economic cyclicality, and you also want those with just sort of slightly longer duration that benefit from that benefit most from the drop in yields, improving their valuation. So the type of sectors, or the sector I would sort of earmark as a sort of big beneficiary of this would be healthcare, and I would avoid economically sensitive, cyclical sectors.
Like tech stocks, for example. You would avoid tech?
Well, tech is sort of somewhere in between because it is long duration, and parts of it are relatively defensive. But that wouldn't be I wouldn't say that's the most cyclical. I would say things like resources, industrials, and banks. So the banks is a sort of, we come back to banks and say, look, banks could be due for a little bit of a rebound if the recession doesn't come imminently. But into that recession, they will, they're not the sort of thing you want to hold. So I'm just, in terms of banks, it is purely a technical rebound from a very oversold position.
So you're not fundamentally overweight on banks in the sense that you think their fundamentals are going to be strong into this recession. It's just they've been oversold. I understand. I'm wondering why you think that yields have peaked.
Well, it's simply that there's two things. First of all, is inflation already under control, and some people are saying no, that we haven't quite done enough to get inflation down, and that's a sort of that in a way that's sort of bad news, because there was always this hope for a soft landing, that you can actually bring inflation down without squeezing the economy or into a recession. But to me, it looks like that the persistence of inflation means that we are probably going to need some sort of major slowdown taking us into a recession. And in that situation, you see recessions are non-linear. You think you sort of you've got a controlled slowdown, and then bang, you sort of see this big drop in activity or a sharp rise in unemployment, and it doesn't happen smoothly. It happens very, very suddenly, where the unemployment rate is sort of flat or not, or rising very, very slowly, and then it goes up very, very sharply. And once the market cottons onto that, it says, "Hey, we've sort of gone from a phase A to phase B," and in that situation, yields drop very, very sharply, and that's been true in every single recession going back to 1948.
We do have historical precedents in terms of how long the Fed in the U.S. has kept rates elevated after a peak, and traditionally it's been anywhere between 6 to 8 months, sometimes shorter if you look at the last tightening cycle. Have you done any analysis and speculated as to how long rates can stay elevated once they're done tightening?
It could be, what you said. it could be several months. But I think the key point is that the bond yield, which is much, much more important in driving um, stock market and other financial asset performance, as well as the economy, that moves much, much more quickly. In some senses, it moves, it starts to move ahead of the recession. But the real turning point we found is when the unemployment rate goes up by around 0.5%, because that's often the tipping, that is actually the tipping point at which you go from this sort of potential soft landing to a hard landing, because there's been no incident in US economic history where the unemployment rate rises by just 1%. It goes up either by less than 0.5, in other words, it's just a bit of noise, or once it gets to 0.5, it then goes up by significantly more than 2%, more like 2.5% minimum. So there is this sort of forbidden zone, let's just say, between 0.5 and around 2.2, 2.3, where it's very, very difficult. You just don't get there. It's this sort of non-linearity. It's either soft landing or hard landing, and there's nothing really in between.
Let's talk about the unemployment and what you think is going to happen to the labor market. I think some people were caught off guard by the latest jobs numbers, which saw the unemployment rate decline rather than even increase, because a lot of people do share your sentiment, Dhaval, that we are entering a recession soon. Why do you think the unemployment went down to 3.5%? And keep in mind, the labor force participation rate in the U.S. has continuously gone up.
Yeah, so what was really interesting is that when you look at unemployment, that the BLS break it down into 5 components, and the bit that sort of saved the day was this component called re-entrants. So re-entrants are people who come back into the labor market, and obviously when they come back, they're unemployed at the start. But the re-entrants dropped, and that's what sort of kept the unemployment rate low. Because if you actually look at the other big swing factor is this thing called permanent unemployed, people who basically get fired. That went up very, very sharply in the last 2 months. Incredibly sharply. It's gone up by close to 500,000 in February and March. So if we look just at that part, we'd be saying, hey, look, things are deteriorating. But as I say, the re-entrants save the day. But the re-entrants can't save the day forever. The big swing factor in unemployment is this thing called permanent unemployed. That's by far the biggest sort of longer term driver of it.
You mentioned a key point here. People are getting fired at a higher rate. I've heard the argument, and please, address this argument, that businesses don't usually fire or lay off employees until we're officially entering a recession. Now, my question is, are fire rates a coincident indicator of a recession or a leading indicator of a recession?
No, they're coincident, because they're completely coincident. But the problem is that there is a tipping point. So what we found is once this thing called the permanent unemployment rate. So this is the number of permanently unemployed people divided by the labor force. When that increases by about 0.3, that has always been a kind of real-time indicator of a recession starting. And we can take that back, 50, 60 years. So we're close to that. We're not there yet. We're about 0.2 or so. But 0.3, as I say, every single time we've had a recession, that's been a kind of real-time indicator that we are entering. And we're close to that, but we're not there yet. But in terms of what's causing companies to lay off people, it's very simple. It's profits. Once your profits start to be under pressure as a company, you have to react. And the thing is, that's only starting to happen about now. But when I say profits, this is a really important thing to realize. I'm not talking about S&P 500 profits, because the S&P 500 is not really that representative of the US economy. Most of the jobs created over the last few years are in these small mom and pop companies. in the middle of nowhere. They are not these sort of multinational companies that dominate the S&P 500. So we want to see economy-wide profits start to flatten and go down. And then that's when you start to see layoffs occurring. We're kind of getting there now.
Are you seeing any evidence of earnings contracting over the next few quarters?
Well, as I'm saying that the in some industries we've already seen it. So what I'm saying is that the earnings contraction in the stock market actually started before the economy. So what I'm saying, we've got to distinguish between the stock market and the economy. The economy profits are what's important for unemployment, because most companies are not listed on, most employers are not listed on the stock market. So this time around, what was interesting was the S&P 500 profits actually started to roll over last year for various reasons. I mean, obviously they've got sort of global exposure, not just US exposure. But what I'm saying is that in a recession, they do drop very sharply. So there is further downside to go in the S&P 500, even though we started. We tend to, in a recession, earnings fall by 20 to 25% minimum, and we're nowhere near that yet.
Have you looked into which industries have been most affected by layoffs and will continue to see more layoffs?
Well, interestingly enough, this time round, tech was the sector that got first hit, and there's various reasons for it. I mean, I think that there's a sort of bigger story here, which is that profits in tech have gone up for many, many years. They were boosted massively during the pandemic. But one of the key sort of structural tailwinds for tech has been this sort of growth of what I call Web 2.0, which is sort of the interactive internet. But that growth model is now being sort of put into question by all these sort of rules about how these companies can use our data and sell it on. So this sort of structural headwind hit at the same time as tightening of policy, the fact that they had very, very strong profits and overhired to a certain extent. So that sector's already been hit by layoffs. We've seen the start of it quite aggressively, but not yet across the mainstream of the economy. That said, as I point out, if you look at the non-farm payrolls and look at this component of unemployment called permanent unemployed, that has picked up quite sharply in the last couple of months.
Have you done any research into how severe this coming recession could be and potentially how high the unemployment rate could go, keeping in mind that in the last great financial crisis in 2008, it went as high as nearly 10% in the US. Is this going to be as bad, worse, not as bad? What do you think?
So this interesting thing is that you could argue that the recession in individual economies is not going to be as severe as it was in 2008, because the sort of imbalances that preceded are not as great. You could actually say that the major imbalance really in the US, in my opinion, is this sort of labor market imbalance, whereby a lot of people left the labor force during the pandemic, and they're trying to just bring demand back because supply has gone down in the labor market. But it's not that big an imbalance. But here's the interesting thing. Normally, when one major economy has a recession, another major economy is at the opposite end of the cycle and can save the global economy. So that's always happened. Now, when Japan had its major downturn in 1990, of course, the US kind of saved the day, because Japan was actually the second biggest economy. When the US had its major downturn in 2008, China stimulated like crazy and saved the global economy. So this time around, what's interesting is there is no major economy that can save the day. So individual economies like the US may not have a severe recession. It might be a mild recession, but everyone might have a mild recession together. So at a global economy level, that's quite important, because you're not going to get a sort of counterbalance. So from a global economy perspective, it could be that everyone has a mild recession together. So that's not too good.
And what does this mean for an investor? What does this mean for the S&P 500?
Well, I think that there's some bad news and some good news. So the bad news is, I think profits do have further downside, because they haven't really factored in a recession. They have weak, they've come down, but not sort of recession type of decline. The good news is that the big rise in bond yields is behind us. So the prospect of yields coming down is greater at this point of the cycle than it would have been in previous downturns. So net, this will limit the downside of the stock market. There will be some downside in a recession, but it will be somewhat less because we've already had we've had a massive hit from higher yields hitting valuations. So overall, I think we can still go down. The S&P 500 can go down into sub 3,500 from where we are now, which is we're at 4,100. I think we could go down to sub 3,500, but given that we started at whatever 4,850, by my calculation, we're sort of over halfway from peak to trough.
Right. And you did mention the sectors that you would be overweight during this recession. Finally, I want to talk about monetary policy. Do you think this banking crisis that we saw unfold over the last month or two, did that have any impact on Fed policy going forward or the ECB? Certainly, the UBS buyout of Credit Suisse has rattled a lot of European investors. I wonder if that's affected ECB policy at all.
So the answer is that the central bankers are kind of caught in a bind, because if they overreacted to it, they'd risk losing control of inflation. So they say, hey, we've got a sort of banking crisis.
Yeah, just on that note, the Fed balance sheet has ticked up significantly since the crisis started. So yes, you're right.
Yeah. So what I'm really saying is that they could make two big errors here, which is that if you overreact to the banking crisis, you basically, and it turns out to be something that's contained very, very quickly, then suddenly the inflation problem that you've been working so hard to contain gets uncontrolled again. And the other extreme is you sort of say, look, the inflation problem is by far the bigger problem, so you just keep tightening aggressively, and you've got a banking crisis that doesn't resolve quickly, and you over tighten, and you take the economy into a severe recession. So far they just steered the middle road, and they said we're not going to lose our focus on getting inflation under control, but we're very cognizant that this banking crisis is brewing. But as I said at the very beginning of this conversation, you should expect fragile banks at this point of the cycle. And maybe central banks know that, so this is what we're kind of expecting. One last point on this is that they also realize that what matters ultimately for the economy is the interest rates that the average consumer or company is borrowing at. It's not the Fed funds rate, it's not the treasury yield, because very few people borrow at those rates. It's things like the mortgage rate. It's like the high yield corporate bond, bank lending rates. So these have a credit spread in them. So if credit spreads are widening, as they have been, that means by definition the Fed doesn't need to do as much, right? Because the tightening is doing their job for them. So net they will not have to do very much more, because this is the other really interesting thing, is that people think rate cuts are going to save the economy. But they don't initially, because credit spreads are widening and going the other way. So you or I, as a borrower, might think, hey, the Fed or the Bank of England are cutting rates, and my interest rate's going to drop, but it doesn't drop quickly because the spread is widening in the first stages of a recession. So of course that allows the central banks to cut, but those cuts do not feed through to the average person very, very, very quickly at the beginning of a recession.
I think there's also the aspect of, if they do cut prematurely, it might send a signal to investors that the economy really isn't doing well. That might be a negative shock.
Correct. So if you look at the Fed minutes or you look at the ECB minutes, this was discussed in a lot of detail. So and basically what they said is, look, we've had this shock in the banking system. Even if it's resolved, in other words, we don't get this sort of cascade of failures and deposit flight. One thing we know is that banks are not going to be lending as readily as they were previously. So they're kind of doing our job for us. But they need to see the data before they calibrate their position. And they just didn't have the data at the last meeting. ECB didn't have the data. That data is going to take some time to come out. And then they calibrate their decision.
One final question, Dhaval, I'll let you go. You've written extensively about your fractal trading system, which is very interesting. The theory behind it is very interesting. I know we don't have 7 hours to go over how exactly this works in detail, but can you just maybe in layman terms explain why you think examining the complexity of a market, which is ultimately what looking at fractals is important for a trading system?
This is quite interesting because I know that you had, if I'm correct, you had Eugene Farmer.
I had Dr. Farmer on last week.
Yeah, and this is quite a provocative thing to say, but I actually think that the efficient market hypothesis is wrong in practice,
Okay.
and obviously he's the guy who sort of came up with this theory. Now, let me explain why I think it's wrong. The thing is, the market is efficient only if all types of investors are participating. So at the one extreme, you've got your Reddit day trader. At the other extreme, you've got your sort of Warren Buffett, and they're completely different investors. I mean, there's nothing in common between these two investors. So, when everyone is playing the game, it's a really, really good sign because the market is efficient because all their information is in there because they're all playing the game. And this is characterized by complexity. If the market is showing complexity and you can measure it very easily, it tells you this is good, right? It's healthy because all the parts that should be contributing are contributing. But when the complexity breaks down, what it's telling us is that, Warren Buffett is saying, look, I'm walking away. I have no idea what's going on. And I'm not therefore putting in my information about the valuation or, whatever the long-term investors do. And it's these day traders that basically start ruling. And there comes a point at which that cannot go on. So what's interesting, all investments have this sort of limit of complexity or lower limit of complexity. And that's telling you the long-term investors have walked away. It's all being sort of, it's being taken over by short-term investors, but it cannot be sustained because you need this sort of healthy mix. And that's kind of the essence of what we're doing. When you get to that point, the preceding trend is very, very vulnerable. It could be either way. It could be a very strong rally gets exhausted, or a very strong sell-off meets a major resistance point. So that's the bottom line is look at the complexity of any investment or the price evolution. When that complexity disappears, it's like a really big red flag.
Sorry, what do you mean by that for the average investor who may not be a trained economist? How do you examine a security's complexity?
So this is the really good thing about this is that you don't need that much. The only thing you need is price information because the complexity is in the price action. So without getting into the mathematics of it, because we have very limited time, there's something called concept of fractal structure. So what you're looking at is the sort of the price evolution over a given time frame. It could be short term, like 65 days. It could be long term, like 1 year or 5 years. And you can just measure the complexity of the price action over that period using this mathematics. It's measuring the fractal structure. Although it sounds quite technical, it's when you get down to it, it's not as complicated as it sounds. And here's a really simple way of explaining it. The least complex price evolution would be if you had a perfect straight line, right? A perfect straight line for the last 65 days. That is just zero complexity. But of course, in practice, the market will never get to that. You will never have a perfect straight line, but you can get very, very close to it in a very aggressively trending market. It's almost like a straight line. So that tells you the complexity has broken down. And at the other extreme, you have a sort of a market that's sort of, wildly going back and forth, which is showing complexity. So those are the two extremes, a market where, there's a sort of back and forth between long-term, short-term investors. That's really good news. A very aggressively trending market is a lack of complexity, which is bad news.
Final question. So when the complexity breaks down, you liken this to checking your heart for a potential heart attack. Not giving financial or medical advice here, but when you do examine a breakdown of complexity, either within the markets or your health, what should you do?
Well, it's like, as I say, it's a red flag. So if you should get, if you get an ECG, and not many doctors do this, but some will do it because there's been a lot of medical research. You get your ECG, they do a sort of fractal analysis of it, and it says the complexity of your ECG has disappeared. That's a sign of a very unhealthy heart. A healthy heart has high complexity in its electrocardiogram. So if you do that analysis and it says, hey, your complexity in your heartbeat's broken down, then you need to change your behavior. You need to do things to your life to get back to health. In the markets, when that complexity breaks down, it's telling you you're approaching a potential turning point one way or the other.
All right. Very good. Dhaval, I appreciate your time today. And where can people subscribe and learn more about your work and BCA's work?
Yeah, so just Google BCA Research Counterpoint, and you will head to the appropriate part of the website, I hope. Counterpoint is one of the many strategy services that BCA offers. So that's where you'll find it.
All right. We'll put a link in the description below. Thank you very much, Dhaval. I appreciate it.
My pleasure.
Thank you for watching. Don't forget to subscribe.